And once again, we are live with Exit Liquidity. I have Captain Rational, continuing to be rational in an irrational world. And we are, as always, presented by Blockmates. However, we are now back on our old channel, back in our old house, the Exit Liquidity YouTube channel. So you can actually like, subscribe, comment there, and you'll be informed whenever we put up new videos, all that stuff. So absolutely do all that because this is our new home, new old home. We were just in a vacation home before. So, but
We'll
we are
be back
here
there one day.
and we have been notably absent. We've been trying to find a time to get together and then do this stream, and it just our schedules have not coincided. But here we are today, and a lot has transpired in the following weeks. We, I feel like the whole Japanese yen thing blowing up was a very interesting evening. I was actually at work all night watching that happen live, and it was quite something to behold. It reminded me of I also was at work when FTX blew up watching, and I just happened to be watching things. And then way back, I remember also being at work, and this was back when I didn't like look at charts nearly as often as I do now, but I just happened to be looking at the charts during the flash crash. Back in what was that, 2014 or something, and going, what on earth is going on? But yeah, I mean, it was a wild night. I don't know.
Volatility.
I mean, I think we were messaging back and forth a little bit that night, if I recall correctly, but it's I think a lot of people learned what a carry trade was. Um,
Got to start somewhere.
because basically, and I actually did a show on Leviathan News recently where I kind of went through everything that happened there. But like, I'll give a brief synopsis, I guess. We can go over a little bit kind of what happened there. But like, look at, oops, I don't have my screen shared. Hold on. Boom. So this is the Nikkei index. And this is a hell of a candle.
Regression.
What's that?
It's not even. It's a transitory mean regression.
Yeah. All that leverage basically got soaked right back up again, though. From everything I've read from people that are in the business of vol, it sounds like all the same players that unwound all those positions during this just rewound them back up. And so it
They
was
got
a
the phone call saying it's all good. The put's in place.
well, there's some of that. there's some of that. Maybe that is what it was. Maybe you just didn't get complete capitulation. But the night that this was happening, this is the monthly chart. The daily chart is a little different here, but it was just boom. Like, it was basically, this was one night, I think, basically.
Remarkable.
Yeah, it was a hell of a move. It went down like 11% or something like that, 13%. Can't remember exactly. But all driven by currency, right? Like, you got the Japanese yen that all of a sudden what happened is a bunch of people that were borrowing in yen, swapping to dollars, buying US treasuries, buying whatever dollar yielding assets of choice they wanted to lever up on and get those DeFi degen levels of yield.
Look at that, a bit of a rejection from support. So a breakdown,
So
and yeah.
I'm looking at this chart here, and I'm wondering, where we seem to be retesting new levels of strength here.
Trends are the lowest tier of technical inspection.
Yeah, I mean, we'll see. I mean, I think that basically what happened is the dollar strengthened very quick, or I mean the yen strengthened very quickly against the dollar after devaluing for a long period of time. It was just, and it goes through these fits and spurts. I mean, like, look at this. Like, along the way, sometimes it does this thing, but then we hit this sort of double top here, where the Bank of Japan was like, oh crap, like they were actually starting to see inflation. They were getting concerned about the level that we were hitting, and that they were going to lose control of their currency. And
Bear in
so,
mind, like their yen appreciating, if they're concerned about inflation before, an appreciating yen is something even more so to be concerned about with regard to inflation, especially for a gross importing country.
again, this is something that's going to have to be managed, and I don't think they want this thing going too far out of either of these, like, I don't think they want this thing to appreciate too much. And so the problem is they have massive amounts of debt, and debt is deflationary. And when you pay it back, it's deflationary, right? And so when the delta between US interest rates, which are coming down, and Japan interest rates are coming up, that pushes money out of the US towards Japan, and that money is then used to pay off the debts that were employed for this carry trade.
Yeah, so it's such a big world, and broadly, yes, but obviously the arbitrage. So there could be lower interest rate or higher interest rates in other nations or investments in other nations. So as always with financials, it's certainly not black and white. I think the broadest inspection or statement that could be made is that it pushes capital out of the U.S. It signals the top in the carry deploying borrowed yen, cheap yen to just U.S. investments, because if it's going to weaken here, that may open opportunities in other nations.
True, but I feel like out of all the other nations, the reaction function of Japan and the US, frankly, are some of the best understood by the markets right now, because you could see when the Bank of Japan or the Ministry of Finance or whatever was willing to take action. There were certain levels at which they were willing to take they were going to take action at. And so I feel like the Bank of Japan here, there are things that they need to do, right? They need to raise interest rates, but the problem is they can't raise interest rates too high too quickly without
Pull it all up.
risking strengthening the yen too much, and blowing up this carry trade that has existed for ever, in varying
Just bear in
degrees.
mind, Very, very important to note is blow up. Folks often talk in finality or just conclusiveness or like a holistic
Yeah,
experience.
that's
It's an
a fair point.
unwinding. You have to deleverage, and it's a pressure.
It's a
It's
pressure. That's a good
forcing
word for it.
the deleveraging.
Yes, that is true. When I say blow up, I don't mean like, yeah.
Well, we all do. Everyone talks in terms of blow up.
Yeah, it's just more exciting to talk that way, but you're right. It's not necessarily accurate. But as you can see, we've bounced off of this long-term support here that dates back to at least 2021 where
Remarkable.
um so it's clear the Bank of Japan and the market is aware that the Bank of Japan needs to raise interest rates. And the Fed, by keeping them as high as they did for as long as they did, um, was putting immense pressure on the yen by encouraging this carry trade. Because in order to go long carry in this particular trade, you are selling yen, buying dollars, then buying dollar denominated assets. And that constant sell, 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 that weakens the currency. And now that they're having to raise interest rates, uh, you're going to see here that it's just going to get stronger and stronger because it's going to force more and more unwind.
You know what
Um,
an interesting relationship is? So, so a strong dollar decreases available dollar supply. Isn't that an interesting statement? So obviously, if the yen is starting to
yeah,
strengthen, that implies dollar is weakening. And when you have a weaker dollar, the world has the capacity to increase dollar supply. You understand those mechanics.
yes. Well, they have to sell dollar denominated assets to access those dollars. Um, but yeah, the think about this from the perspective of the yen, though. Um, all that Japanese debt is denominated in yen. And now the yen is getting stronger and stronger and stronger.
So the
And
dollar is getting weaker. So
and so
maybe
the
it's
it's
dollar debt. Have you seen those headlines lately? That they're issuing dollar debt based on pooled collateral? So
yes,
maybe,
I have pointed I pointed those out. I tweeted about those.
so there's the
So
dollar supply that I mean. So it changes the
well,
denomination of the
I
debt.
I think what that is that I have a suspicion. So just to let me see if I can even find what we're talking about here. Let me
That's an
see.
interesting headlines. Pooled collateral.
Yeah, yeah. So basically, let's see. Did I send that to you directly? Hold on a second. Yeah. Let me check my Twitter feed real quick because it's somewhere.
Apologies for a couple of nibbles here and there. It's lunchtime and the captain is famished.
Yeah. Yeah, I just stuffed my face right before we went on. But let me see here. There was yes, here we are. Let me just share this. Let me pull this off screen. Here we are. Okay. So these are the various.
Oh, oh my! I can't. You know, they're literally making dollar loans because the weakening of the dollar makes it
What
more favorable.
what's interesting about these though, and I do want to talk about these. What's interesting about them is that pooled collateral of what kind
That's always
and what
check.
denomination. Like, it doesn't say dollar collateral. It just says pooled collateral. And there was a thread by Concodonomics that basically, let's see, it's in here. So this thread, Concodonomics, was actually talking about the fact that, look at this. So tri-party repo has been doing weird crap lately, where it's actually fallen below
Lower bound.
the what should be the risk-free repo rate, which is the RRP. This is overnight RRP right here is 5.3, and yet people are suddenly pushing it down below 5 basis points below the risk-free rate. Why are they doing that? Why are they doing that? And I'll tell you, my suspicion is what's actually happening here. And Codonomics goes into this, which is the smoking gun here. All these other rates, these are all pretty normal. Like corporate bonds are up here at 555 basis points, 535 basis points for U.S. Treasuries and federal agency securities, 525, or about 530. That looks like maybe a little under for federal agency securities. So there may be some, of BOJ maybe doing some operations here too, just because these are also kind of sitting at the floor. But this one right here, what the hell is going on here? This is
monetizing the shit.
Other riskier collateral. Like, what does that mean? And I suspect that these two things are the same. Part of the same. Look at the dates on this. 7/29. BOJ to provide USD funds against pooled collateral starting from 0801. And this 0801, 1st of August, was the day that the carry trade unwound. So the question I pose is like, what are they doing here? What are these like, are they, say you're the Bank of Japan here, right? Like, you have this dollar strengthening and you're trying to balance two things, where you got to keep your bonds in order and you've got to keep your currency in order. And so how do you balance those two things when you are, I mean, they're sort of up against the wall here.
Of course.
Demographics were terrible for a very long time. They accumulated huge amounts of debt. They ran way too much QE. Their central bank is saddled with tons and tons of JGBs. They basically own the JGB market.
But they print the bond, they monetize it by themselves, and they owe the interest to themselves. So in this fashion, how do you support the currency? By using pooled collateral of the shit on your balance sheet to create dollar currency units, which takes the pressure off the Forex market. They're printing the debt.
So basically, you're
printing dollars.
You're printing dollars using yen.
Yen
presumably,
yen-denominated debt.
Yen-denominated debt is being used to print dollars here. So you are essentially shorting volatility in your own currency. And you're doing it like you are the carry trader. The BOJ have become the carry trader. They are like, oh, and they've doubled down on that bet because my balance sheet's infinite. I can do what I want.
Now you're thinking how I tell so many of the things. 'Cause everyone's so afraid of systemic failure or the
Well,
volatility of the word crash. But you have to take it a step further of how perverted everything is and realize that the governments are doing things such as this, and we're understanding the mechanics of it. And it's clearly past the point of no return to the point where it's an exercise of global collusion to manage the system.
right. And it's like, so they've pushed these rates down. Presumably it's them. Like I don't know who else it could be, but to me, this feels like the smoking gun. This feels like the smoking gun as to why repo rates for this other risky collateral has gone nuts. And I don't know who's accepting this collateral at those rates.
It's very interesting.
Um,
One is a domestic entity because we have, U.S. domestic regulators considered. But, I often think of international conditions. I find it fascinating the concept of the liabilities flows. I, I, as much as I understand of global finance and how the dollar is fundamentally a liability, how does the dollar really flow? Because the dollar is a liability and a double entry accounting balance sheet. So how do those units flow? Because that basically means they're probably shifting. They have to shift around the asset side of the balance sheet from institution to institution. So that's something that's on my mind quite often. How knowing
well, and the
how
thing is, they've found new and more obfuscated ways of hiding it too. Because like the Fed is mandated to report a lot of things. And so the places where you would normally, when someone needs dollars, right? We have all these ways of catching the knife and all these Fed apologists. I get so irritated with these people on Twitter that are like, oh, well, the Fed will never have another dollar crisis again because the Fed has solved that problem. Bullshit. Like the market will always find a way to express itself.
it's an
That
interesting statement. They say that the dollar is a Fed liability. It's literally a Federal Reserve note. But given the amount of dollar debt globally, the dollar is far more a global liability
it is a
of
global
other central
liability,
banks than the Federal
but
Reserve. In fact, the Federal Reserve is a minority participant in that liability.
and and when the federal balance sheet grows, it's because we're taking those liabilities and putting them onto our balance sheet in order to bail out the rest of the world so they don't stop using our dollar system and so we don't lose the soft power of being able to take people out of our system. We want to pick and choose who gets to stay in our system. We don't want the system to blow up the people we like because it allows us
Well
to
said.
hold power over them, and much to the detriment of our own population.
And we're at the point where they're going to finagle pooled collateral from Japan to
Yeah,
finance dollar liability expansion to drive down the price of the dollar cyclically in a secular trend over the coming decade to achieve secular lows,
yeah,
structural lows that we discussed on the DXY. And that entrenches the dollar globally and increases the capacity for the world to print dollar liabilities.
yeah.
And it's just going to be a weird next 10 years.
Well, I mean, and who's the counterparty here? Like, I really want to know. Like, because I think this is an important question. Is somebody else was counterparty to these uh transactions, right? Like they're supplying pooled collateral in repo at below the risk-free rate.
The FOMO facility,
And
Federal Open Market Operations, FOMO.
but if it was through open market operations, I mean, they didn't say how much, but if it's through open market operations, it would appear on the Fed balance sheet, right?
Mm-mm. It's a a private contract entity, as we've discussed, that is not. It's just it's a shadow organization, an
Well,
institution, a subsidiary. There's no relationship. You got to
so
go further. You got to
I
get more real.
no, no, no.
Keep
I
on going.
mean, it could be any one of their associated banks that they.
There you go.
I mean, I I'm just saying that if it was actually the Fed doing it, it would show up on their Fed balance sheet. And it's funny
Oh yes.
because so this right here, um, wait, that ain't it. Uh, let's see. Here we go. Uh, yes, this right here is the other factors supplying reserve balances. So this is on the asset side of the Fed balance sheet. Uh, foreign currency denominated assets, Wednesday level. Uh, unsurprisingly, shot up over $1 billion over the last few weeks.
Tiny. So
It's
little.
not a lot. It's not a lot. So that's clearly not where all of this is hiding. And that's but that's all I could find. I went looking.
It's off the books. It's off the. It's you gotta get cynical. You gotta get more cynical.
Although there's also this, and this is something I pointed out, I think maybe on the last podcast, is this uh the reverse repurchase from foreign and international accounts. Like
All right,
this,
397. That's getting there.
so this thing started shooting up. Um, every time this thing starts like creeping up, it's associated with like movements in the yen. Like you get a big move in the yen, and then oh, this thing starts shooting up. Um, and so I marked another one when we had a big yen move in at the end of July. And then all of a sudden, you know, the yen moves started getting really big, but like I don't know, like how. So my second question, besides who's the counterparty, because there's clearly no way to do this because the central banks have learned how to collude in the dark, and they've learned how to do it outside of the typical balance sheet reporting, um, because they're
There we
sneaky.
go.
They're
I
sneaky
like this
like that.
side.
No, no, no.
Let it
I mean,
flow.
you're not you're not telling me anything I don't already know because I've been looking at the balance sheet and it's not
Not
doing
there.
any of the things that I would expect it to do for the amount of
Movement.
like movement that we've been seeing. And you know, there's two possible explanations for that. One, the over levered got washed out, and this is all purely, you know, natural price action. That's one possible theory.
There
But
is nothing natural.
yes, the way this thing was arrested that fall, it there was nothing natural about it. And so that one seems probabilistically unlikely. Um
There you
and
go.
and having just read Nassim Taleb's Fooled by Randomness, I am, you know, now more sensitive to thinking probabilistically, but that one seems improbable. Um, so that leaves us with someone was counterparty to this, be it another bank, another central bank, a primary dealer, somebody, or maybe a big hedge fund. Uh, who knows? Somebody curried some serious political favor, perhaps, and they
Yeah, it's like
they
who
caught the
wants to
knife.
be a counterparty? You're going to be off the books. You're going to have
Well, I
implicit,
mean, it's
you know,
on your books. It's on your books in that look at like I was didn't flip off of it, but
little
like
small number,
that going back to
397.
that repo chart, like you're accepting this risky yen collateral at less than the risk-free rate, and you're providing that um, dollar lending. Why would you do that?
To prevent the
Why?
system from blowing up.
Well, aside from that, though, like as let's pretend this is some sort of private entity, like you would have to hedge that somewhere, right? I mean, because this is repo. This is not like a a Fed facility, right? Where there's infinite balance sheet. The balance sheet is finite insofar that presumably this is a public marketplace. And for whatever reason, market participants within this marketplace, maybe some of it was the Federal Open Market Committee, providing support there. But then there's also like, but if these were private actors that were doing this in support to could gain some sort of political favor or whatever, they're generally hedged, right? Like these types of players, they just capture little spreads. They people that participate in the repo market are not. I mean, some of them are highly leveraged hedge fund types that are taking a directional position, right? But typically the counterparties. I mean, I don't think it's the hedge funds that are going to be doing this type of action, right? Where you're taking an extremely directional bet that you think the dollar is going to become so devalued over the next few months that you're willing to lend out dollars in return for yen. Like, I mean, maybe people are just betting on yen strength.
Cyclically, yes, but
I
I
mean,
also believe in the concept of disposable entities, the garbage can.
yeah, I
And
mean,
it's you don't have to back. So if the Fed doesn't even have to implicitly or explicitly back some third-party entity that has been colluded into existence, designed to accept the shittiest of collateral to print liabilities, they just need an FOMC or a master account at the Fed.
yeah,
And there has been a fair amount of very questionable, weird named master accounts that have been issued. And oh, it blows up. Oh, it's sovereign shit debt. Oh, all right. All right. So they get swept under the rug. It's all
yeah.
disposable.
Well, and here's another thing that's interesting to think about. Pretend you are the FOMC, or the open market, or not the FOMC.
FOMO.
Yeah, Federal Open Market Operations. Um, Maybe that $1 billion is actually a derivative position that's been marked to market, and you have sold hedges against the BOJ's dollar position. Like $1 billion in derivatives positions can go a long way. Um, like towards hedging a particular risk. Uh, and I don't think you can necessarily just look at the dollar values because the Fed clearly plays accounting games. Just look at this chart right here. This ought to tell you that the Fed is playing accounting games. Hold on.
I wonder if I wonder if they're private, like 501c3 or Chapter 501, not for profit entities. I wonder if there was a way to determine if anyone with a Fed master account is a not-for-profit entity, because that sure as hell would be a very
Well, they've
interesting.
been very cagey about who letting out who has Fed master accounts, which because I don't know if you follow Caitlin,
Caitlin.
yeah, from uh forget the name of her bank, but yeah, she's been fighting to get a Fed master account and the Fed won't let her. And so she's been, trying to get all of that information through freedom of information requests. And whew, I mean, like, there's,
I mean,
there's a
seriously,
lot of,
how?
there's a lot of weird stuff going on behind the scenes of the Fed. And yeah, yeah.
I just see as remarkably plausible that a not-for-profit entity with a Fed master account that is a disposable entity that has balance sheet capacity, is able to accept assets and print liabilities using access to Federal Reserve systems,
Yeah.
and
I
is
mean,
able to encapsulate this type of systemic collusion that we've seen.
pretty much everything that the regulators try to uh stomp out from the private markets is things that they have done in the past, like repo. Did you know that repo was actually like invented by the Fed? Like the concept of a repurchase agreement was invented by the Fed to get around federal regulation. Like, I don't know. But I wanted to talk a little bit about interest rates because,
Mm.
like, a lot of people feel like interest rates being lowered is going to be bullish.
Oh,
And
oh no! Don't say things like that to the captain. Oh dear. I mean, listen, notable in the real economy. But we're not interested in the real economy. I mean, clearly we are because we visit stores and shit. But the real economy, there's two separate economies, as I talk about. There's
Yes.
the real economy and the financial economy. The real economy, yes, is bullish, but it is an extraordinary leading indicator, like really long into the future. Give
Right.
it a year, give it 2 years.
There's a reason they talk about the long and variable lags of interest rate policy. And I think we 100% are headed to a recession.
Of
Because
course.
let me just pull up the unemployment numbers real quick. Where are my
Like cutting
I have so
rates
many
avoids a
indicators.
recession.
I have so many indicators. So all employees total non-farm payroll. I mean, that's been up and to the right. Uh but the problem is the unemployment rate is doing this. And this is what scares the Fed. And Jerome Powell even said this. Caitlin Long, that's her last name. Yes, some Sir Joe from the comments was kind enough to remind me of her last name. Anyway, aside from that, look at like the history of when recessions happen. Look at these recession bars. When the unemployment rate spikes like this, that's when the recession starts. Like
Quickly,
every time. Every time.
very
Look,
quickly.
and look at this. And then you're gonna tell me, nah, 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 nah. This time's different. We're not gonna be in a recession this time. Uh I I'm not buying that story for one. And there's and I'm not gonna base any sort of decision on uh you know just one indicator. But that being said, why is this not working? Why
I love the
are
time frames on that chart.
yeah? I mean,
I love long-term
it's
time frames. Look
it's
at that.
it. This is where the Psalm rule came from. It was literally her observing that, hey, uh, man, every time we, I mean, I know that recessions are kind of determined after the fact, but like this is not good. This right here is not good. And generally, we tend to go parabolic uh shortly hereafter. Um my bottom chart here is supposed to be the let me just kill this. And then
You know, it's strange. Like, you get a big recession, you're 6, 7, 8% unemployment. What is it, 10, 15% of all credit card debt is 90-day
yeah.
delinquent. Then you have
Yeah.
a complete
I've got that
explosion.
chart. I have that chart too. But look at this. Look at this. Look at this. This is when the Fed starts cutting rates right here, right when things start ticking up. Uh-oh, unemployment's rising. When does unemployment actually peak? Not till you hit the absolute freaking bottom. Like up, unemployment's peaking up, peaking up, peaking up, up. How long does it take before the real economy actually feels any of that? Oh, we didn't peak until just before the final rate cut in 03. All
Those
right.
years.
Yeah. All right. Here we go. How about this one? Uh June of 1990. Okay. Oh, yep. Uh-oh, things are getting bad. Better cut rates.
The bottom.
Boom, 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 boom. Up didn't peak until 1992.
Mm.
June of 1992, almost 2 years later, the unemployment rate peaked. So, I mean, we can keep doing this, but every single time there's a rate cut, it takes nearly 2 years, and then they finally stop cutting at the peak. So, now, that being said, that is the real economy. Let's go back and talk about the financial economy. Let me find the good old SPY chart or
For those of
SPX.
us here, for those of us here that don't
Because,
invest in the real economy, because I'm not too fond of investing in
right.
the real economy, because I
I
think
mean, I
it's
have a
best.
real job, so I am invested by way of
I'm already
having.
invested. I am way too invested in the real economy with the job. I am sure as hell not going to invest my money in the real economy.
Absolutely. So you will notice, and maybe we do this. Maybe we do this. So look at where actually. I mean, you don't even need the Fed funds rate or anything. Look at where we peak or bottom, I should say, during these. We need a different chart. Let's go to the monthly chart here. This is a much more appropriate chart. But look at where the S&P 500 bottoms in recessions. Like generally, we tend to bottom right in the middle of the recession, somewhere in the green band, whereas the unemployment rate, as you recall, tended to peak like right at the end or even after the end of the recession. Um, and so the stocks, they are a leading indicator, and they have not begun to lead. Uh so
This is the S&P. I'd like to know, ladies and gentlemen, that this is still the real economy. The S&P.
yes,
But then again, maybe
is
it's
it?
not. Maybe it's like
Is it? It's
equal
not.
weight.
It's the global dollar asset economy because
Oh,
people,
okay.
I mean, how many stocks does the Swiss central bank own? Uh
Good point.
So
But maybe it's
look
equal weight.
look at the time frame on this fucking chart here.
Now that is captain approved time frame right there.
So why are you doing this? Okay, this
Oh,
line.
generational trend lines.
So this goes all the way back to May 1932. So we broke through that back in 2013. We broke through it back in 1995, then had the giant asset bubble that was the dot-com bubble, and it basically did a peaking process over the course of the next year of tagging that thing a couple times.
Do you see that this is literally a resistance flip support on like a rising wedge?
What do you mean? Oh,
Yeah,
like
2000. The bottom in 2000 was a resistance, a rising wedge resistance flip support. Rising wedge is generally a reversal type of structure.
yeah.
Clearly not. It's not.
Well, and
Oh,
then September 07, basically we double topped there, right? Boom, boom. Then we dropped all the way down to this trend line that, again, this one got messed up too for whatever reason. So I'm going to fix this because these. There we go.
previous resistance flip support as well.
There we go. But like we have tagged this upper trend line here from bubble territory, major bubble territory in 2021. We dropped down and then tagged it again. Now the question is, do we blow right through this and just go full parabolic stupidity, or do we first have a correction? And I am of the opinion that it's going to be we're going to experience some things first before like this whole up and to the right thing. I
Would it
don't
be?
think it can sustainably go on forever. You need to have some sort of deleveraging.
Yeah, 20,000 to 7,000. That's a deleveraging.
I mean, we could go back and retest this. I'm a buyer of the S&P at 3,200.
What? So you could get a whopping 2x on a return to all-time highs. Literally, it'd
Well,
be a two.
I mean, I
2x.
do have a 401k, so
That's something to fix.
yeah, that's something to fix. Yeah, it's not in my trust. What am I doing? But I guess my point is that like we could blow right through the top of this thing too. Again,
Yeah.
probabilistically, I don't think in terms of, and anyone who tells you they can speak with certainty about markets has not spent enough time being humbled by markets.
Yeah, without a doubt. It's all
um,
probabilistic. So I like to think in terms of what is it impossible? And in this world currently, nothing's impossible. And my phrase is it's weird. There's gonna be some weird shit.
yeah. And so everybody thinks that the Fed put is on, but let me kind of explain some of the things that I see as being bearish about interest rates coming down. So everybody talks about like Fed liquidity, right? Like, and how that has been pumping us. And that explains this big run up is like, okay, there was the drain down in the TGA, there was RRP that was draining down. Well, let's check in on some of those things, right? So let's see. Okay. So here's the RRP. Oh, I still have this in logarithmic. Let's take it out of that. That looks much more like it. When you go back to 1932, you got to go logarithmic, or the chart just looks silly. But I like to invest in things where looking at the logarithmic chart makes sense.
Oh, I see what you did there.
Because, I mean, let's do a real quick fun aside here. I'll
That.
come back to that in a second. I was looking at the chart of Berkshire A.
Aw, good old
Look at
Warren.
look at this logarithmically.
Who
Look,
slammed by in May?
what's
Who
that?
fat fingered that wick in May?
I don't know. That might just be bad data. You can never count out bad data. Actually, we need the 3-month chart here. But look at this. This is a logarithmic chart, people.
Up and to the right.
Up
Oh,
and to the
beautiful
right.
chart.
Just look at this. It doesn't like. I mean, there was 1998 to 2003. So basically, Warren just sat there and was like, I don't get this whole .com bubble thing. And it was just like, I'm just going to stack some cash. Just stacked mountains of cash. And then made oodles of money. And then lost a little bit during the financial crisis, but he also bought like a huge chunk of
Everything.
Goldman Sachs and a bunch of others. He went on a freaking shopping spree with all his cash, and then just back to up and to the right. And like being able to produce an asset that just makes sense on a logarithmic scale
You know
over
why?
that time period.
He operates mechanically.
He does. It does. It's just he has insurance companies and cash flows, productive
Whoa.
assets, that produce cash flows, and he just stacks those cash flows. He stacks them and stacks them and stacks them. And then when the time is right, he deploys and just buys things cheaply.
At a
I mean, it's a
discount.
very
Oh,
rational approach.
I love that
Anyway,
perspective.
yes. So this is the RRP facility. So the reverse repo facility was designed to hold cash. It was basically dollar staking, where you get paid by the Fed at an interest rate of 5.3%, in order to keep short-term interest rates high, because that's the part of the curve that they have control over, the most control over, I should say. And so they implemented this facility and it raised the interest rates up. And just like when Anchor did it for Luna,
Yep, same thing.
it attracted a bunch of money. Money flowed into this thing, and it sucked excess money out of the dollar liabilities. Let's be specific here. It sucked dollar liabilities and turned them into liabilities of the Federal Reserve. It transformed them from private dollar liabilities to liabilities of the Federal Reserve. And so it sucked in $2.5 trillion, which is an appreciable sum.
Yeah, it's
And
getting there. That's on radars.
you're no longer in negligible territory there. And
Yeah.
what's interesting though about this is let's look at the maybe the weekly chart here, because this is where it gets a little more interesting, is this thing has sort of bottomed out. Now, there are two sides to the reverse repo facility. There is the internal facing one, which is for the domestic banks, and then there is the one for the foreign entities. Actually, I
Which
think
actually,
this is this is both. This is both of them put together. So you can look at this chart. This is like everything in the reverse repo, because the WLRRA, if you're looking for it, is the one so this is the foreign component, which is the one that's been kind of still trending upward. So this tells me the fact that this is going up while the other one is going down tells me everything that we've been saying about what the impact of raising interest rates is. You are pushing money by raising interest rates. You are pushing money out of the domestic system into the shadow banking system, or the broader dollar system. Look at this. I mean,
there's more capital coming in from
yeah,
foreign
like
entities
as
compared to
soon as they
domestic.
started raising interest rates, whoop, this thing goes up, 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 up.
Because you got to remember, this is excess capital. Because what is capital
Actually,
and what's the purpose of it? Is for buying things and investing in things. Anything that's going into reverse repos is just shit sitting around doing nothing.
right. And so you want to keep track of that stuff. But what this tells you is that money has been moving out of the domestic US. So by raising interest rates, you're hurting domestic US productivity in favor of the broader dollar system. You're pushing dollars away. But the problem is that average people aren't terribly interest rate sensitive in the US, because I mean, most people have a 30-year mortgage, or some have like a 15-year mortgage that is all fixed interest rate. Like, there are very few floating interest rate mortgages. People have car loans and stuff, so that's why those are the only like interest rate sensitive purchases that the typical American makes, and those have rolled over and died.
Oh
And
my God, dude, I gotta digress for 2 seconds. I saw on X 104-month loan on an $80,000 car for $1,300 a month. Dude had a 300 and something credit score. I don't know if it was a joke or not,
I
but
wouldn't be surprised if it was real. There are I who why I mean, oh, that is not rational. That is not the rational way of doing things. A car is a depreciating asset. Uh, do not get a 104-month loan on it.
104.
That is financial advice.
Yes, you see, I told you it's good. We could do that. We could.
don't don't get a 100-year mortgage. Don't get a 40-year mortgage like they're trying to shill right now to try to prop up these property prices.
You see that
Because
in Canada? The
yes,
principal interest only mortgages.
interest only, that way lies madness. Do not. Interest only mortgages are the type of crap that we did. Are they going to roll out some ninja loans too?
That's the type of crap we did
That's
to our
in
U.S. education.
2007, or yeah, in 2003 through 2005, we were doing all that. Like, go watch The Big Short again, Canada.
Yeah,
Uh,
right.
but anyway, so like you have this RP facility that's kind of filling up. This is the amount of money going into money market. So that's still, this is all, shadow bank money as far as the Fed is concerned. So you've got this RRP facility. Where did you go? that domestically is draining. And so obviously this rundown of $2 trillion flowing back into the economy is bullish, but you can see that this is slowed to a trickle. And then the other thing is, the joint chart of the foreign plus the domestic doesn't look any better, honestly. And so why has that slowed to a trickle? Well, because people know that the party's almost over as far as this is concerned, and repo rates have gone up generally in most aspects. And so that money can be more productive elsewhere. And that's why people have pulled it out. Or people want to buy bonds with it or do whatever. Whatever it is, they don't want to be, when this thing was going down, they didn't want to be in here anymore because the stock market's going up into the right. People are, speculating on buying 30-year bonds and whatever because they know the Fed's going to cut rates at some point. So we had this big move, this big liquidity injection here, right? And then the other big source of liquidity is the
Wait. Reverse repo. It's gonna be very interesting because we haven't had rate cuts in 2021. Reverse repo came online, and we haven't had rate cuts since what, '08.
reverse
So
repo was around during prior like cycles, just not $2 trillion
that's structural,
worth.
and
Yeah.
so what's interesting is as we start cutting rates and bonds appreciate and interest rates on them come down, if they're going to have to lower the reverse repo rate, otherwise, who the hell is going to buy the bond if you could get 5.5% on reverse repo, and 10 years are at 3.5. So the question becomes, why would anyone put cash into U.S. debt versus reverse repo? So I'm very curious of what the reverse repo rate does in the coming year.
Well, I think this thing's well, here's part of the thing is I think the Fed wants to keep this as a buffer for one. Because once this goes to zero, you are kind of you're right now we're still got our hands on the kid and we're as he's learning how to ride the bike and we're making sure he doesn't fall off. And letting this go to zero is you letting go and going, all right, market, you got this.
Don't
and
got this.
and the what happens is if you get a dollar shortage, it can't come from here. This is a pool of dollars that you can pull from in the event of a dollar shortage. So I honestly think that the Fed may be using open market operations to kind of manage the RRP at about this level in order to maintain, you know, what's their word for it? Adequate reserves, I forget.
Smooth market function.
Well, yes, basically smooth market because yeah, they used to want abundant reserves, and then they changed the language to something less than abundant, but more than
Semantics.
it is semantics and it's technocratic bullshit. But anyway, this is a bit of a buffer. It's a $350 billion buffer just in case liquidity gets short, the repo market can suck out this emergency fund. This is the Fed's savings right here. And,
It's like a
if
month
the,
worth of federal.
yeah, it's not a lot. But so this thing is basically tapering off, and I feel like they're just going to manage it so that it stays right around 300 while they lower interest rates because they have a bad history of knowing when they don't have enough reserves. Here is their history of reserves. So like this is what they have what is called the lowest God, what is that stupid acronym? Lowest comfortable level of reserves, LCLOR. And August 2019, we hit this level. October 2012, we hit this level. That was when they started QE3, I believe. And August of 19 was right before the repocalypse. Then we pushed a bunch of money into the system, and then we were all good to go until January 2023. Anything of note happen in early 2023?
Bottom.
Well, that's when in March
Thanks.
SVB failed, FRB failed, and Signature Bank all failed. And then they introduced that new facility, pumped some more money in, and notably, this is trending back down again. So they don't. I think they know they don't want to necessarily get back down here. Maybe they're that smart. I
It's very interesting. Look at the MAs. They really pushed it to, what was that bread? The bread's got to be like a 200 or something like that.
yeah,
I'd say 200, 150 with the green.
yeah. Look at
Fascinating.
that. It is fascinating. So bringing this back to the just general bear case for interest rates is how has the Fed been paying for paying this reverse repo? Well, when this was up here, it was costing them a lot of money because you're paying 5.3% on $2.5 trillion, right? Well, and that's money that's going back into the economy. It's like people can pull money out of the reverse repo. And so like that money made its way into the market, and you can calculate exactly how much or at least pretty closely account for how much, because you have where are you? It's not that one. Yep, here we go. This is how much we spent.
Financing it.
$191 billion in remittances that we no longer were giving to the Treasury, because the
Deficit
Fed
spending.
is required to give any of its like profits basically back to the Treasury.
Which is interesting because that is an increase in circulating supply of capital because they're paying that interest on reverse repo, but it was never taken out of supply vis-a-vis remittance. That's an
Right. So
increase
this
in
is
supply.
basically monetized. This
Hmm.
is how much of the Fed's balance sheet got pure straight monetized. And so $191 billion, it's not world changing money, but it's a lot. And the fact that you can see that this thing slowed down a little bit, but we're still losing a lot of money here. And I mean, I guess it's over a different time frame. So we got to kind of be careful what slope we're looking at here when we can toggle back and forth between this and the RRP. But like this should, in theory, if the RRP is their greatest expense, as they lower interest rates down towards the I hate this term, but the natural rate of interest, or
Wait,
R.
isn't it funny? Why don't we look at the 10-year real quick?
All right,
Just
10-year it
humor me in
is.
the last couple of minutes. I got a hard stop at 2, but let's
Oh,
take a
okay.
look at the 10-year. Uh, very far out, please. Yearly.
Yearly. Here's a 6-month chart.
Okay. Compressed vertical. So they keep
Enhanced.
saying, there you go. They
Uh,
keep saying what the neutral rate is like 3%. Some of the Fed governors.
yeah.
Where's 3% on this bad boy?
3% is right about here.
Right about on the yearly, maybe the MAs line up a little bit more, but it's ironic that that
Here's
it
the yearly.
really
I don't even
hits.
have that one starred. I am not
Maybe
rash.
there is no MA there. It depends on what you got. But
We bounced right off the top of the 100-day
uh,
or 100-year moving average.
these are good time frames. But look at that. That is a breakout from a falling wedge, which we'll see a resistance flip support. And if you put it on logarithmic, that might give the more aligned perspective.
Makes my lines look silly, but
Yeah, the top line. So watch the top line. If you adjust, if you don't mind adjusting the resistance line blue, you'll see the 3-month basically aligns, I
I'll
believe.
just draw a new line.
Let's see my chart. I was staring at it the other day. I was like, oh shit, no joke.
Wait, which like on the top or the bottom are you talking?
Let me pull up my 10-year.
Yeah. Just pull up your chart.
Yeah, check this out. Logarithmic. You said scale. Oh no. I just I find I find that neutral rate they keep talking about quite fascinating because no
Well,
matter what,
they pretend like it's a knowable thing
yeah,
what the neutral rate of interest is. And when you're manipulating the market as severely as the Fed is, uh and all the central banks are so deeply manipulating the price of time, which is the name of a wonderful book I just read. Highly recommend everybody go read that. But when you're manipulating the price of time as much as the Fed is, you have no idea what the neutral rate is. So you're just guessing. You're just making things up and pretending like it's a real number that you can actually measure. You can't.
well, bear in mind
Stop
what
it.
Fed funds
Your
versus
model.
what was it 2-year? A lot of folks show that chart where 2-year yields deviate below Fed funds. They're like, oh, that's the top. So in the end, the market may dictate Fed funds rate. Forward looking, of course.
Yeah, that's interesting. I hadn't heard that before. I have some of these interesting charts though too that are like the this is like the 10-year minus the this is the constant maturity 10-year versus the current 10-year, which is an interesting thing to look at, like kind of what it does over time. Obviously on a 12-month frame it doesn't tell you much of anything, but it does give you some interesting information about Treasury
Spreads.
volatility and things. Um, yeah, if this thing looks super compressed, well, the everything's being managed, and if it doesn't, then like look back here, like in the 80s when we weren't so active with the Fed, like this thing was all over the place, and they were raising interest rates like crazy. But everything has gotten so managed that, especially like during COVID and stuff, they kept all this stuff nice and tight. And now, things are widening out a bit.
Lower
Tends
highs.
to tends to happen during some of these recessions here where things kind of widen out a little bit. But anyway, like I want to real quick. What time do you got to go?
we're coming up on it.
All right. Very good. I'll wrap it up real quick. But my overall point is that, okay, the RRP's not really a factor. It's slowing to a trickle. Janet Yellen, no way she's going to drain down the TGA too far with a debt ceiling battle coming up in 2025. So there's no source of liquidity there. And in theory, the Fed should not be deficit spending by way of the Treasury once interest rates drop, because that is what, this has been where their costs have been coming from. And lowering that interest rate lowers how much it costs for them to pay on this facility as well. So,
You know what fixes it? A little bit of QE and cutting interest rates, and they'll be able to pay it back in no time.
actually, I
Just
think they're
throw-
talking about continuing QT for the time being.
Ooh, they're going to have
Well,
even less revenue.
yeah.
The productive balance sheet is how the extra capital they pay for Treasury. So they got to come up with a couple $100 bill, or was it
Yeah.
180 bill?
Yeah. And so, I mean, maybe that explains, as they sell these things off via QT, maybe they're realizing capital losses. Although they're not actually selling. Never mind. That was stupid.
They're just maturing.
They're just maturing off the balance sheet. So it's just a matter of what they're buying. And as they lower interest rates, though, all the things that they've been buying with that expanded balance sheet are appreciating. And so the Fed all of a sudden may start actually remitting to the Treasury and make some of that back. Like, you may see that chart actually reverse.
I will sell high.
Yeah, I mean, that's what a central bank is supposed to do, right? Is they're supposed to provide liquidity in uncertain times, take a pound of flesh from you for the service, and then let you go on your way in a truly idealized version of, in Badgett's view of what a central bank ought to do.
The volatility suppressing.
The 1800s idea of what a central bank should do. You short vol, and then when things are calmed down and assets move back up again, then you make money. But the thing is, if the Fed's making money, like this whole time, the Fed's been losing money and we've been making money. If the Fed starts making money, who's losing money?
We are. Uh-oh.
And the Treasury also has been, having to pay interest on all this stuff. And so once interest rates go down, they stop deficit spending as much. That's bearish, right? Because they're not spending as much, and they have and especially if all this crap like drops at the end of the year, like this whole time we've been trading and whatnot, and realizing all kinds of capital gains, then they let the thing fall to the floor, and then they pump it back up again and make sure they take their money from you by way of taxes, and then rinse and repeat. But like, if the Fed actually starts making some money off of this giant vol suppression activity that they've been participating in the last couple of years, then we aren't. And this is the same thing with, like, Druckenmiller was criticizing Yellen a while back for not like
refinancing,
pushing out the duration of the Fed's balance sheet, which actually I don't think was even correct, because during I believe the Fed's or not the Treasury's balance sheet is at something like 71 months, which is actually historically very high, relative to where it has been historically, which I think is closer to 60.
Hmm.
And so like, but if the Treasury is winning or the Fed is winning, the markets are losing. Like when they issue these things, like, and if Janet Yellen stops issuing T-bills as much, then that's less money like substitutes in the repo market. Rates get high, dollars get scarce, people sell things. I
This
I
is
do not.
top inspection, my friend. We are not even at the start of the cycle. I would argue that overwhelmingly is relevant to assess these characteristics of economic conditions, but I would say they are more significant in top inspection.
What do you mean by top inspection?
So, I mean, frankly, from an alignment standpoint, almost everyone talks about sometime in 25, 26, structural top, recession. So I think we start to see the central bank structure, the flow from a central bank perspective change as you're illustrating, but more so towards the top. Uh, Something happens, reverse repo down at 50 bill, or maybe it's up at a trillion just because something structural of volatility in one of these core volatility suppression programs, and that is something to take note and observe when we get closer to what would be a time frame that people are looking for top. The
Gotcha.
volatility, it blows up, and then everyone's in a scramble for cash and they sell anything they possibly can.
Gotcha. Yeah.
Ah, interesting.
Huh. Yeah. I mean, I think that's a good place to leave it. But not necessarily like, just to bring it all back to the title, I guess. Like the world may be awash with dollars. Um, but
They're gonna get cheaper.
you're always long something. And the fact that people are choosing to long dollar or to uh to sell dollars um doesn't necessarily mean that they're buying your bags. um or it could just be leverage unwinding. Could be a great many things. It could be.
I think a great takeaway is where we're heading, in my opinion, over the next decade is to a increasingly cheaper dollar relative to foreign currency. But the takeaway, consistent with what your thought is just now, is that even though the dollar becomes cheaper, let's say over the next 10 years, in fact, that will further increase the dollar supply around the world and further entrench it in global economic activity.
Right. Like I think what's happening here is some of this manipulation is being done ahead of time in order to pad what they know is coming, which is trying to prevent something like this, where you get this dollar run up due to people scrambling to pay down all their dollar denominated debts. They know that people are going to start selling things if there aren't enough dollars. And they're very, very scared of that. And so they're trying to make sure that there's sufficient dollar liquidity before they pull the rug out on the liquidity machine, because they know the liquidity machine is running out. Um, So they fire up the shadow liquidity machine.
FOMO operations, yes.
Yes, by way of FOMO operations, and maybe try to pad the landing as they bring in the Fed balance sheet in for a landing.
You see a nice dip to 98, 97, and that will create a significant buffer as they start cutting rates.
Yeah.
Would that be
Yeah.
an interesting inspection to see rate cuts in DXY terms? Because I think it's
Oh,
reasonable to say this time.
yeah. I'll pull that up. Boom. So, in general, cut rates, and it starts a bottoming process in the dollar.
The
Cut
system cannot
rates.
tolerate that. They need to
Well, at
create the
least it
bottom
did
lower.
there. That's a sample size of 1, so let's not extrapolate too much from it.
Hmm.
I guess this was a topping process. This was a bottoming process. So it really depends on circumstance. Again, this was in the 80s. It was a bottoming process. It really depends, and there's a guy I follow on Twitter. What's his name? Fijao. He has his own show on Blockworks. I think he's on the Margin podcast. Dude, highly respect him for his macro takes, and he is on the opposite view as I am, and I don't like when him and I disagree because we so often agree about so many things when it comes to global macro plumbing. And so I could be wrong. But I feel like the Fed is kind of late in their rate cut cycle this time.
Certainly.
And it was part of a topping process here. So maybe we do get dollar weakness.
There you go. Maybe not that far, but they say at least the 90s.
Down to 90, maybe. Yeah. Maybe we do get continued dollar weakness, but that doesn't mean, because if foreign entities, right? If foreign entities own dollar denominated assets and they just sell them into dollars and then use those dollars to buy yen or yet buy euros or whatever, the dollars are left on the market, you know?
Cheaper dollar. That's my 2 cents.
Which means cheaper dollar and
I
cheaper
say
assets.
90, the bottom at 90, bounce to 100, 100 to 90, get some chop, and he blow through to 80. But I expect a fresh lower low over the next 10 years.
A lower low over the next 10 years.
65. There's a trend line there. Look at those bottoms. Look at those lows.
Interesting.
Oh. Why? Because in a rising interest rate environment with higher lows and higher highs, you can no longer manage systemic liquidity of the dollar.
Yeah. Well, yeah, that actually, you know what? That actually all makes sense. That you would need to devalue the dollar systemically in order to support the debt of flagging demographics. So,
and how do you repatriate supply chain with an expensive dollar? You need a cheap dollar. And cyclically throughout history, as we could see printed on the DXY, we have periods of dollar devaluation to facilitate these political and geopolitical goals. Hypothesis and observations.
Very nice. Very nice. I think that is very interesting. Yeah, that is very interesting. I think we should leave it there. This has been my thesis, but I don't know. I don't know where we're headed. I don't know
Nobody
where we're headed.
does. We'll
Nobody
see. All we
does.
do,
Anybody who
we get to
says
see.
with certainty they do,
I have no idea what they're talking about.
they probably don't know what they're talking about. So
I like the structure and symmetry of it, though.
I
We'll keep up on it, and we'll
we will
inspect.
keep up on it. We will follow. This is part of having a macro thesis, right? Is you have a macro thesis, and then you follow it, and you look for signposts along the way. You say, if my thesis is correct, I should see this and this and this and this over the coming months. And as long as you continue to see something within that channel of expectations, your macro thesis just might be valid. So
Proof, validation.
indeed.
That's a good signpost.
All righty. Well, thank you everyone for signing on today. I saw we had DeFi Advisor and Raul, Sergio, Tapsy. So
Some of the crew, the
thank all
regulars.
you guys for coming on, and please subscribe to the YouTube channel. We're going to be streaming from here from now on. And then like, comment, and until next time, don't be exit liquidity.
And be more rational.
And
It's always a good thing.
be more rational.